Welcome back. Economic Background, Part 2. The next part, welcome back to Economic Background, Part 2. We're looking again at what the current situation is. And what we're seeing is we're talking now about labor. Now, labor has really two impacts. If you think about the economy growing, it's because consumers are buying more. Remember the $14 trillion. So if they're working, they're having money and they're spending it, which will cause the economy to grow. The other thing that goes along with that, if you want an economy to grow, is you need workers to produce the goods and services. So it's an interrelated thing. And right now, we have over 7 million jobs going unfilled in the U.S. because of a lack of skills. Now, what we're seeing today is that based on the November numbers, January will be ready the first week in January, or December numbers will be available the last week in January, and you could see that overall we have 3.7% unemployment. That's below what we'll call a natural level. Now, you can see what the unemployment was during these periods here, which are shaded, which were recessions, which are 2 quarters of negative growth. And you can see that we had that in 1992 to 94. We see one here in 2001. And then we see the Great Recession here, where we really saw unemployment going from just about 5 well up to over 10. And we've seen it since 2009 when it peaked, coming all the way down to 3.7. So it's a very positive number, but that implies that there's not much slack in the workforce. So if you're thinking about this, if jobs are available and there's 7 million 7 million jobs unfilled because of a lack of skills, you really got to start saying, well, when is inflation and wage pressure going to come? We haven't seen that yet. Next one is sort of scary. It's the civilian labor force participation rate. And this takes everybody in the U.S. and says, who's participating in the workforce? And as you can see, since the Great Recession, it's significantly declined. Significantly declined from the 90s, when we were over 67%, to 63%. Now, if we just use rough numbers of 300 million people in the U.S., a drop of 4% from, say here, when we were over it in 2000, down to 63, that's 4%, and 4% times 300 million is 12 million people who are no longer in the workforce. Now, that's for those 18 and older, so that includes you, because you're in school, you're not working, and the retirees. But this number has hovered around here as less people are in the workforce. So when we look at this here, this is 3.7% of those in the workforce. So that's the participation rate that we're talking about. Now, this is an interesting one when you compare the U.S. to the rest of the world. The U.S. being this blue line here, and the red being advanced economies ex-U.S. So this means Japan, this means Europe. And if you can see, when we look at prime age women, almost 80% are in the workforce compared to about 75% of prime age. Okay, that doesn't include you, but you should look at this just prime age, not everybody. But now those that you would expect to be in the workforce, those from 34 to 54. And now we look at the U.S. and we can see that in the U.S. we have less people participating in the workforce than does the rest of the world, the developed world. So this is an interesting thing, but I think it's looking as part of these mega trends that we talked about in the first video that are starting to come along. On a good news basis, this is the unemployment rates for persons 25 years and older by educational attainment. And as you can see here is the bachelor's degree and higher was just a little bit over 2%. But when we look here, it didn't get as high as the general population did. Remember, that was 10%. But look at those. If you didn't have a high school diploma, the unemployment rate soared. Okay, if you had high school, no college, again, continues to be double that of college. So you can clearly see that on a statistical basis. Though if you have a college degree, you're less likely to be unemployed statistically if you have the right skills. Let's talk about college education, because I think this is sort of an interesting thing, but I think it comes into account as to what's happening on this global basis. In 1977, when I graduated from college, 34% of the U.S. population had a 4-year degree or higher. Today, it's only 38%. Not a significant change over that period of time. But by state, it's runs between 28 and 50%. So you start to think about this, and that's a big, that's not much of an increase. And when we look at it by state, 28 to 50%, and there's over 7 million unfilled jobs today because we don't have the skilled people. Let's look at some neighboring countries. Canada, 56%. Japan, 51%. Israel, 50%. Korea, 47%. So what we have is that we could keep going with these, but the level of educational achievement in the U.S. is not keeping pace with the rest of the world. We're well below the average, and we're getting weaker as other countries are spending more on education. When we look at this, those working in a city versus a non-metro area, again, you can see that those in the workforce, if you're living in a city, metropolitan area, more people are in the workforce. Less people are in the workforce when you get to non-metro areas. Look at the salaries that are made, the distinction between urban and rural. So this becomes a self-fulfilling strategy, or a self-fulfilling prophecy, if you will, because why would we go to work in yes, the cost might be different, but there's huge gaps here. Less people in. So what we're seeing is in the U.S., we're seeing a distinction between metropolitan areas and rural areas, becoming very, it mirrors along the educational maps that we see. So what we're seeing is that higher postings in certain areas and lower postings in other. So it gives you a sense of where jobs are. And college, when you look at the number of openings, what we're finding is the job openings are for those with college grads. I mean, this is the red line here. In college, it's just an interesting thing. Some of this may come back to, just to point this out. Let's take that out. We don't need that. We now move into section 3, which is what's the impact of policy. So we talked about these global trends. We talked about what the current situation is. And now we're taking a look at what is the impact of policy. And what we're seeing today, number one, is central banks are heading in the same direction, reducing stimulus, raising rates. So this is the first time we've seen that in a while. We still have issues with Iran and North Korea. Trade continues to be a huge discussion. That's a major impact today. Healthcare, regulation pullback, infrastructure. Everybody talks about it, but there's no plan. We're still seeing some of the impact of the Tax Act, the issue of cybersecurity, polarization of society. Right? We're seeing this toxic word being used, and that was the dictionary word of the year was toxic. So let's take a look at some specific policies here. Trade, the value of one currency compared to another. Some of them are market, what a willing buyer and a willing sellers. Others are pegged, that if the dollar moves or the yuan moves. From a U.S. perspective, the higher the value of the dollar means imports are cheaper, okay? And exports from America become more expensive for other countries. So because we have a strong dollar today, we're seeing imports go up and exports go down because it's cheaper to import things than for other countries to buy from us. So it's predicted to remain strong. So that number we've seen on imports isn't going to change as long as we have a stronger dollar. And trade agreements involves what can be traded and what taxes if tariffs are added. And this is an unknown. We have the new North American Free Trade Agreement, which hasn't been ratified by the Senate or the Congress yet. And it essentially is the same bill, just same act as NAFTA, just redone a little bit. But the risk we have today is China, who will be hurt. Now, tariffs, you think about this, is if you impose tariffs on imported goods, who is going to pay for them? The bottom line is the consumer is going to pay for them. So if the products go up 20 to 25% that we import, and we import lower value goods, those are going to go up substantially. And those are going to impact low to moderate income individuals much more so than it will the wealthy. But it isn't absorbed by the companies, isn't absorbed by the manufacturer, isn't absorbed by government, it's absorbed by ordinary people. So if you look at Walmart, Walmart has about 25 to 30% of what they sell is imported from China. So those prices are going to go up. Do you think Walmart's going to absorb that 20% price increase? No. If you believe that, well, then it'll work. But they're not going to absorb that. The manufacturer's not going to absorb that, and that's going to be paid by you, the consumer. So that's the risk of trade. And as you remember from the global trends, we're interrelated. And the other parts of the world are developing faster. So this is a big risk. And as you can tell from the next slide here, is that when you start breaking it down of what we import, what we export, it's consumer goods that we import, automobile parts. So I think we got to start thinking about that in that broader sense. What are we seeing? We had the Tax Act last December. It's giving us a sugar high right now as people are spending, but this is the impact of how much the GDP. So if we're going to take here fourth quarter, we're seeing that spending and the tax cut is growing, but by the time we get through next year, this is a sugar high and it'll be gone. Next thing we have is the Healthcare Affordable Care Act, which moved us to a more prevention and lower cost-based model instead of emergency response. Lower cost, better outcome. A hospital has to treat you irrespective of your ability to pay. The Affordable Care Act also standardized coverage definitions, included mental health, chemical dependency, so you could compare policies that you knew that at different levels they all covered the same thing. So if you're looking at a silver policy from firm A, it's the same as a silver policy from firm B. So those gold, silver, and bronze. So you could select what works for you so that you could know what the definitions are and what's covered. One of the biggest pieces, adult children are covered till 26. So you right now are covered by your parents' health insurance for the most part. So if the Affordable Care Act is repealed, you're going to be on your own to find insurance, and that will impact you significantly. Under it, you can't be denied coverage because of pre-existing conditions. So when we look at this, only about 10, when you look at where insurance comes from, you find that employer and group plans only account for about 46. Medicare and Medicaid, Medicare is for seniors, Medicaid is for lower income individuals. So we really have a piece here that about 10% is not covered by one of these programs. And that's about 30 million people at risk. So now if you think about it, if they need health care, they're not going to go to the doctor. They're going to wait till they're really sick, go to the emergency room where they have to be treated and hospitalized, but they're going to be a lot more costly. Now, let's take a look at this because policy is very important because it's going to impact the future. And as we look at different companies, we're going to see how they may or may not be impacted. This chart right here, as you can see, the U.S. spends on average $10,348 per person. And when we look at other developed countries, such as Switzerland, Germany, Netherlands, Australia, etc., the comparable average is $5,169. So really, when you look at it, we're spending twice as much as the average and significantly more than some of the other countries, Belgium, Canada, Australia, France, Japan, and the UK. So now, if you think about this, so we're spending a lot. Wouldn't you assume that's good? So that obviously our health must be better. But this is what we spend. Let's look at the health outcomes. Let's start with life expectancy at birth. Oh, the US is at 78.8. 81.2 is the OECD median. Infant mortality per 1,000 live births. We're the worst. Percent of population age 65 plus with 2 or more chronic conditions. We're the worst. Obesity rate. We're the largest. Here's one that we're lower on. And percent of the population over 65. These are health outcomes. There's multiple ones, and there's many, many more. So the question really becomes, why is it that we spend double the average of a developed country per person on healthcare, and our outcomes are poor? The one difference is we are the only developed country that doesn't have healthcare for all. So these countries have moved to a prevention-based model where we prevent problems which are cheaper to treat than if you let problems go. So that's a big thing in here. When you look at it, this is further how bad the opiate use is. In the U.S., 6% of the population uses opiates. That's huge. But look at some of the other countries. They don't use it. Okay, they don't spend as much, but when you look at it, higher use. Continuing on, this opiate use has had a negative impact on our society. If we look at the deaths per 100,000 people in the age 45 to 54 group, what you can see is that in the U.S. since 1990, the death rate per 100,000 has grown for white Americans, 3.4. Every other country, the rate of death has declined, meaning they're healthier and living longer. Hispanic Americans is down 31%, consistent with our other countries. But white Americans are dying faster today than they did 20 years ago. So this is part of it. We now take a look at oil prices. Again, oil is part of our society. Energy is. We use it for transportation. We use it in production. And it can also drive inflation, and it can slow inflation down. If we look, this is from this is the nominal, that's the real. As you can see, that it peaked here at about $150 a barrel, and it ran over 100 for quite some time, a couple of years, and then it dropped. It just boom, plunged lower, and then it started coming back up, and over the past couple months we've seen it drop back down. So you say, why? Well, what has happened over time is we see that world production, which is the blue line, and the consumption, when you had more supply than you had demand, the prices dropped. And what we're seeing now, this is where it held pretty good here in the first part of 2018, which caused it to go up, is when supply equaled demand. Now, since the supply equaled demand and price went up, that brought more oil into the market. And as soon as you find that the market is, as soon as we find that the supply is going up, that the demand isn't, that means there's more implied stock or things just sitting around not being used, will drive the price down. And it's not till the end of 2019 as it forecasted to do that. And that's just one source. Others, you'll see some of these that'll actually have more supply coming in. Next thing is interest rates. But again, what drives interest rates? Supply and demand for money. The more money is in demand, the higher the rate. The lower the demand, the lower the price. So if you think about the demand for money, interest rates are low because people don't need the money. Okay? And when the demand for money is high, is stronger, the higher the rate. We're seeing that here in the U.S. as rates are rising. Some of it's the Federal Reserve, but others of it is with the U.S. budget deficit, there's more money needed to fund the government, so they need to borrow more. That pushes rates up. Then we have the risk and return profile. The longer the term, the higher the rate. That goes into the pricing. The shorter the term, the lower the rate. The greater the credit risk, the higher the rate. U.S. government securities have no principal risk, but they do have an inflation risk. We're going to take more time as we move forward to take a look at interest rates. One of the things that a lot of economists and others have focused on is that when you look at what interest rates are, the difference between 2-year money, how long you're going to borrow, and 10-year money generally has had a spread. If we go back to 2014, right here, you can see the difference between 10-year and 2-year was over 2.5%. So that meant, we're assuming it's an equal rate, that if the rate for 2-year money was 2.5%, 5-year or 10-year money would have been 5%. Again, compensating you for taking the additional risk. That spread has been compressing. It gets a little up, and we're now down here that we're only 10 basis points off. The 10-year and the 2-year is almost the same. That, from an economic perspective, is a red flag or a signal. Let's just say it's a signal, because every recession that we've had going back to 87 has been preceded by this narrowing spread, or what's called the inversion of the yield curve, and they've generally occurred after Federal Reserve hiking cycles. So if you look at this, here was the cycle, and the spread condensed, and you have a recession. Okay? Putting it all together, cautious growth. But expect volatility and headwinds. So if you're running a business, you want to be aware of these and plan accordingly, which means how you manage your risk, your growth, how you spend your money. How does this relate to finance? Well, firms operate within an economic environment. The issues discussed impact the firm's ability to grow and the ability to achieve their goals. And they use it to estimate future earnings and cash flow. But how do these things impact you personally? Jobs, jobs, jobs. Predict jobs will be in demand over the next 10 to 20 years. You should focus on your skill development. But it impacts your ability to support yourself and your family. It impacts your quality of life and the ability to create wealth, planning for the future. So all of these things come together that they impact you and the firm. So what you should know from this is some of the key terminologies and where to look at things. Know that there's information on background here. Think of the 3 themes: long-term trends, current position, policy impact. So that when you're preparing for the test, start thinking about things within that context. If you have any questions, please let me know.